Tyler, what do you make of this number?
Well, it's a reassuring number, and as Rick put it, we'll take good news when we can get it. Look, I think this is sort of the easy part of disinflation. A lot of the transitory factors that have been driving inflation, the headline numbers higher over the past year, those are starting to weigh on the number a bit. Things like energy, things like some certain transportation services, things like chips and used cars. But the hard part of disinflation comes next. When you still look at core measures on the consumer side that are looking like anywhere from 5 to 8%. On the producer side, if we're looking at services, that I think is going to be the harder part of disinflation. And we haven't really seen the pain yet. Yes, initial unemployment claims have risen almost continuously since their March 19th lows. And similarly with continuing claims. But I do worry that there's going to be a bit more slack in the economy before we get those core measures down.
Betsy, would you agree? Because the implication is that inflation will remain high if the easy work is done and the hard work is still ahead. Although we still haven't felt the full impact of any of the Fed rate hikes yet. So there's hope, perhaps.
So first of all, I agree. We have not felt the full impact of the Fed rate hikes. You know, one of my biggest fears remains that the Fed over tightens because of not having enough patience to wait for their actions to take effect. I do think that the big decreases are going to come from energy prices coming down. That's what we want to see come down is energy prices. I want to just point out that whole ball of wax. I don't want to see prices starting to come down. Deflation can be very destabilizing for an economy. So right now, look, we need to be clear. We can't change the past, and we're not trying to reverse the past. What we're trying to do is get inflation back down to 2%. And I think when we're seeing decreasing numbers right now, we're clearly on the right track. But, you know, what we want to see is slow, low and steady prices going forward. I don't think we should be thinking that what the Fed's trying to do is undo the past year by rolling everybody's wages back and rolling prices back.
Betsy, my father used to tell me he took the subway down to the deli, got a pastrami sandwich, and got a nickel back when he gave them all a quarter. That's isn't that what we want?
I think we want to keep the past in the past. You know, we've had this price increase. It's a pain, but we've adjusted, and it's passed through on. That's the whole point of inflation. It's passed through in wages. We're going to bring some prices down, but if we see month after month of negative price increases, what do you want to do if you're a company, right? What do you want to do if you're a consumer? That becomes very destabilizing. You want to wait until prices fall further. That could push us into a recession. And I still have a lot of optimism that the Fed's going to orchestrate a soft landing, that, we don't need to see people losing their jobs in order to get this inflation under control.
What do these pieces of inflation data tell us, Julia, in your view?
Well, actually, one of the things to this discussion that was encouraging in the CPI report yesterday is that we saw a real mix of prices rising and prices falling. It wasn't all a story of gas prices falling. We saw a lot of travel-related prices falling. And what that tells us is that consumers are starting to become more price sensitive. One of the things that facilitated inflation during the pandemic was that consumers could only spend their money on a narrow set of items, and they became very price insensitive, allowing full pass-through plus for goods in particular. Now we're seeing consumers, have the full suite of consumption possibilities available to them, and they're responding when prices like airfares go up a lot. Well, they fly less. And so that price sensitivity, it means, yes, harder trade-offs for firms in terms of margins, but it's also the key ingredient that could allow the Fed to pivot away from extremely tight policy, not soon, but somewhere down the road. So that price sensitivity, we look at it, the diffusion index, the number of prices rising versus falling, that was the best number in many, many, many months. So to me, that's the encouraging part of the report. We're starting to see normal behavior from consumers, and that's essential.
So 9 minutes into the discussion, and finally somebody brings up the word pivot, and albeit in the context of a pivot down the road, but still, finally we mentioned pivot, Steve. Could we, with this number, actually start talking about pivot, even if it's next year, late next year? What?
Yeah,
in a more grounded sort of way.
You could be. Look, the Powell process here is to get to that 3.25%, 3.5% range, and then look around at what the data is. I don't think anything stops the Fed from its appointed rounds of hiking up. I've said it has a date with 3%. It's gonna make that date. It's gonna make that appointment. It'll be there. And then you have guys, Kashkari yesterday looked at the CPI number and said 4.4%. I am interested. Is it okay to bring it up? Maybe, I don't know, Mona or somebody wants to comment on this jobless claims number. This 260, which is creeping up, and I think Rick had it talking about it being like one of the highest we've had in a while. I'm not surprised to see it because you think there could be some adjustment going on in the economy. As we reported, there are still sectors that are below where they were in 22. Some are above it, and they're above it because, it's the Peloton effect where they overhired for demand that didn't end up being there.